It's the major hurdle every new entrepreneur faces time and time again, raising money. You've got a great business idea, but how the heck do you get it off the ground? Hi there, I'm David Waring and I'm the co-founder of FitSmallBusiness.com. In this video, I'm going to show you 9 ways to fund your startup. By the end of the video, you'll know which option suits your needs and how to increase your chances of getting funding. So stick around. Startup financing option number 1, get an SBA startup loan. Traditional bank loans and SBA loans are generally the most difficult and slowest way to get money for your business. To get an SBA loan for your startup, you will generally need a high net worth, real estate with equity that can be used as collateral for the loan, an airtight business plan, and a credit score above 700. If you meet all these qualifications, congratulations. That's difficult to achieve. You're likely a good fit for the Small Business Administration's Community Advantage Program and Microloan Program. The SBA's Community Advantage Program lets your startup borrow up to $250,000, and the Microloan Program provides smaller loans of up to $50,000. Entrepreneurs who qualify for these programs have invested at least 30% of their own money in the business and have relevant management and industry experience. Startup financing option number 2, ROBS. The best kept secret for funding a business is a rollover for business startups, or ROBS. ROBS allow you to invest funds from your retirement account into your new business without paying early withdrawal penalties or income taxes. Essentially, you are buying stock in your company with funds from your 401k and holding that stock inside your retirement account. ROBS are best for people who have at least $50,000 in their retirement account. You can find out more about ROBS and how they've helped entrepreneurs invest over $3 billion into their businesses in our ultimate guide to rollover for business startups. Startup financing option number 3, home equity loans and lines of credit. Did you know home equity loans and lines of credit are used by 25% of U.S. small business owners to fund their business? That's because home equity loans and lines of credit allow you to leverage the equity in your home to borrow money for your business. Because the loan is backed by your home, this is generally the lowest interest rate financing option for startups. Home equity loans and lines of credit are best for people who have more than 15% equity in their homes and a credit score above 620. If you meet these qualifications, I highly suggest reading our article, Should You Use a Home Equity Loan or Line of Credit to Finance Your Business? Startup financing option number 4, credit cards. 37% of small business owners use credit cards to finance their business. Credit cards offer you a lot more flexibility than other forms of finance. Plus, you can earn cash back and rewards when you charge purchases to the card. That's basically free money. Using credit cards to finance your business can be tricky. That's why we created a guide to help you choose the right card along with tips on how to use credit card financing responsibly. Give it a read. Startup financing option number 5, microloans from nonprofit lenders. Nonprofit lenders are mission-based organizations that give out loans to people from disadvantaged communities. These are great for startup business owners who don't have great credit or a lot of other options. To get a microloan, you should be prepared to have a cosigner or show a significant source of income independent of your business, like a full-time job or spousal income. If microloans seem like a viable option for you, read our article, What is a Microloan and How Can Your Small Business Benefit? Startup financing option number 6, loans from a peer-to-peer site. Before Kickstarter and fundable campaigns invaded your Facebook feed, P2P loans were the way to get financing from strangers. P2P lenders enable borrowers to get a 3 to 5 year loan by filling out a loan application online and finding investors willing to lend them money. If you qualify, you can get up to $50,000 in just 2 weeks. Now, getting a P2P loan depends entirely on the state of your personal finances and credit score. If your credit score is above 700, you should consider a P2P loan. You can find out more about the pros and cons of P2P loans in our article, Can a Peer-to-Peer Loan Provide Funding for Your Business? Startup financing option number 7, borrow money from friends and family. Family members and friends who like your business idea may be willing to lend you funds. Sure, it may feel awkward, but you can put their doubts at ease with a stellar business plan and a promissory note. The promissory note is a legal document that business owners sign to formalize borrowing money from their friends or family. If you want to know more about how to write a promissory note, read our article, How to Make a Promissory Note to Fund Your Small Business. In addition to showing you how to make a promissory note, we'll talk about the issues you need to understand before borrowing money from friends and family. Startup financing option number 8, crowdfunding. Our second to last fundraising method has become one of the most popular ways to fund a business debt-free. Crowdfunding is when you focus on raising small amounts of money from a large number of people. Platforms like Fundable, Kickstarter, Indiegogo, and Rocket Hub connect entrepreneurs' products with the world. Crowdfunding works best for startups with visually appealing consumer products. Think tech gadgets, apparel, and food and beverage products. If this sounds like your startup, I highly recommend reading How to Crowdfund Your Business before launching your own crowdfunding campaign. Startup financing option number 9. Raising money from angel investors and venture capitalists. Venture capital generally comes from a company or firm, whereas angel investors are usually wealthy individuals acting on their own. With both angel investors and VCs, you can raise money debt-free, but it's important to establish upfront and contractually how much control they will have in your company. If you have a solid business plan with financial projections and you're confident that your business can provide a 10 times return on investment, angel investors or venture capital might be right for you. If you want to move forward with any of the financing methods we've covered in this video, we've created a Startup Funding Essentials Kit with everything you need to know to increase your chances of getting funding. You can download our free Startup Funding Essentials Kit right here. I'm still here. Did you get it? Good. That's it for this video. For more small business videos, subscribe to Fit Small Business. Also make sure to visit fitsmallbusiness.com for in-depth articles and guides to help your business succeed. Leave a comment below with any questions and we're happy to answer.
Did you?
Go ahead, I'll wait.
Yeah.
Okay.
Okay.